All right, welcome to Talk Tickers. Today, we are diving into the Q3 2025 earnings for Concrete Pumping Holdings. That's ticker BBCP. They just reported, and honestly, the market's reaction was pretty fascinating. The stock shot up, but here's the kicker. It wasn't for the reason you might think. So let's get into it.
Okay, so let's just dive right in with the key number that everyone's talking about. Look at this. In after-hours trading, the stock absolutely popped. We're talking over 8%. That is a huge move for any company, especially in this market.
So here's the really interesting part. That massive jump happened despite the company reporting that their revenue actually went down year over year. On top of that, you had management sounding pretty cautious on the call. So what gives? What did the market see that got everyone so excited? Well, that's exactly what we're going to unpack right now. All right, first up, the headline beat. It really all starts with those headline numbers. In an environment this tough, the number one thing investors want to see is simple execution. And that's exactly what BBCP delivered. They managed to beat expectations on both revenue and earnings. So let's start with the bottom line. Earnings per share. They reported 7 cents. Now I know that doesn't sound like a massive number, but the key is it was a penny ahead of what Wall Street was expecting. And in this kind of market, even a small beat like that is considered pretty solid. And that outperformance, it continued right on to the top line. Revenue came in at $103.7 million, which was almost $4 million better than the consensus estimate. So you look at these two numbers, and on paper, it looks like a really clean, straightforward beat. But this is where the story starts to get a little more complicated. So here's that crucial piece of context we were just talking about. Yeah, they beat expectations for this quarter, but when you compare it to the same time last year, their revenue is actually down 5.4%. And that right there is our first major clue that the tough economic environment is really hitting them hard. And when you actually dig into the numbers and break it down by business segment, you really see this mixed picture. Their main businesses, the US and UK concrete pumping operations, were both down. No surprise there. They got hit by that softness in the commercial sector. But, and this is important, the real star of the show was their Eco-Pan waste business. That division actually grew by 4%, a key bright spot for sure. So you've got this weird situation. Revenue is down, but they beat the estimates. So how did the CEO and his team frame all of this on the earnings call? Well, their whole story was basically built around a single word: resilience. Yeah, the CEO, Bruce Young, he really set the tone right from the start. He framed the whole quarter not around how weak the market is, but around the company's ability to execute in spite of it. He kept pointing to things like disciplined cost control and making their fleet more efficient, basically all the things they're doing to weather the storm. And make no mistake, they are fighting against some serious headwinds. I mean, you've got high interest rates that are just slamming the brakes on smaller commercial projects. Then, get this, they had a direct $2 million hit to revenue just from heavy rain in the central and southeast U.S. And of course, with less work out there, all their competitors are getting super aggressive on pricing to win what few jobs are left. So, with all that going on, what's their game plan? You can really see it in how they're spending their money. Their capital allocation, it's defensive, but also kind of confident. They're keeping the balance sheet strong, but they're still investing in their equipment for when things eventually turn around. But the big one, the thing that really stands out, is that they were actively in the market buying back their own stock. And this wasn't just a small amount. They bought back $3.8 million worth of shares in this quarter alone. This is all part of a much bigger buyback plan, and they still have another $20 million authorized to go through the end of 2026. I mean, that's about as clear as a signal as you can get that management thinks their own stock is a bargain right now. Now, even though they beat expectations and are managing costs really well, management was super clear about one thing on the call. A full-blown market recovery, it's not happening tomorrow. It's not right around the corner. So this is probably the most important takeaway from the call, their timeline. They're telling investors to expect this pricing pressure to stick around for at least another 6 months. But, and this is a really big but, they reaffirmed their guidance for the full year. That tells you they're confident they can hit their numbers in the short term. The bigger message, though, they're basically telling everyone to cool their jets on a big construction comeback. They don't see that happening until late 2026, maybe even early 2027. So, let's put all the pieces together. Why the heck did the stock jump 8%? And more importantly, what's our take as we look ahead to the next earnings report? If you're bullish on this stock, there are a few key things you've got to be watching. First and foremost, interest rates. Any sign that the Fed is going to start cutting rates would be a massive tailwind for them. We're also keeping a close eye on all that government infrastructure spending. We need to see that money move from just being talked about to actual projects breaking ground. And of course, you want to see that eco-pan business keep growing and the residential market hang in there.
So here's our prediction. Our thesis is pretty simple, actually. The market decided to reward the company for executing it today instead of punishing them for a recovery that's still a ways off. By beating those estimates and holding their guidance steady, management basically proved they know how to handle this tough cycle. So what about next quarter? We're expecting more of the same, really. The biggest question mark will be just how tough that pricing environment gets in the US.
And that brings us to our rating. Based on how well they're performing operationally in what is, let's face it, a really difficult environment, we are initiating our coverage on the stock with an outperform rating. We think this company is perfectly positioned to really take off when the market finally does recover.
Which really leaves us with one final big question for you to think about. Is this company a classic coiled spring? You know, a really well-run business that's just powering through a downturn, waiting for the moment the economy turns so it can just spring forward.
And of course, we always have to say it, this is not financial advice.